Are you surfing the internet looking for the lowest interest rate? Are you wondering if there's something you can do to qualify for a better interest rate? And what is a great interest rate right now? We're going to cover these questions and much more in today's Lessons in Lending. The number one question I'm asked every time I get on the phone with a new client, someone that's shopping for a mortgage rate or shopping lenders, is what's your rate? The number one question we receive. And the question is basically something that's ingrained in us that there's somehow a way to get a better rate by just shopping around. However, what we're going to do today is we're going to show you what you can do to improve your chances or to improve your qualifications for the lowest interest rate out there. And what we're going to find is it's a market based more on your circumstance, your situation, than any given lender. That is a part of it, but it's a small part of it. And we're going to show you how you can get that best interest rate today. The first thing is collateral. So if you don't have a home, there is no loan. So in other words, the collateral that's backing the loan, if there's something that's held as collateral, in other words, in real estate, it's a home, possibly. Your home is the best collateral there is. U.S. real estate's high in demand, and it's one of the best asset classes out there. So what we're going to do is we're going to see that first. And the way that comes into play is what's the loan to value on that asset? In other words, are you borrowing half of what that home is worth? Well, that's a very solid risk for the lender. If you're borrowing 97% of that value, in other words, if you're purchasing a $500,000 home, and let's say you want to borrow $475,000, that is going to be a much riskier loan than someone that put $250,000 down in that $500,000 home. So the asset itself is the number one thing. Without the asset, there is no mortgage. So then we look at the qualifier of how much are you borrowing against that asset. That's what raises the risk. So the higher the risk, the higher the interest rate. So we want to look at that. The way to lower that risk for the lender is mortgage insurance. So when you do put less down, there are multiple ways we work with you to lower that risk by using mortgage insurance, either FHA mortgage insurance or conventional mortgage insurance. And those types of products insure the lender against that additional risk. Some of those mortgage insurance policies expire after a certain period. Some of them you have to refinance to get rid of the mortgage insurance. So you'll have to talk to your loan officer about all those options. But that is one way to lower that risk and to lower that interest rate for you. The second category is credit. Your credit is a factor in that the willingness to pay is measured by your credit score, frankly. Every 20 points on your credit score, beginning at 620 for a conventional loan, 580 for an FHA loan, and every 20 points that you improve that score, your rate will improve. So that's something you have control over. It's something you can work with. What we do here at Unitas Lending is we offer something called a what if scenario, where we pay for the cost of running that algorithm against the bureaus to see what we can do to get that score up quickly. To go further, we help with credit restoration and sometimes refer that to a company that specializes in that type of thing. So that credit score is a key indicator of that willingness to pay and thus the risk to the lender. The less risk, the higher the credit score, the lower the interest rate. The third category is income. So when we look at your income, or any lender looks at your income, they're going to want to see that you have solid, stable income. If you're self-employed, that's considered more risk. If you're W-2 for 10 years, that type of thing, it's a very stable loan as far as income. The stability of the income is another risk assessment that's taken, and that implies a higher rate for the higher the risk as well. So because you're self-employed doesn't automatically put you at a risk that's higher necessarily, but if we can show that you've had that business for over 5 years, for example, that will help you as well. What we can do beyond that as a mortgage broker is we have access to non-QM programs where we can look at bank statements to show deposit history, that type of thing. So there are a lot of different programs we can work with to help you qualify for the best rate for your situation. The next way to look at your loan to get the best loan possible is working with a broker versus a bank. A bank has few options. They're limited in their options. A broker can go to many different lenders to shop your loan for you. They also look at the lenders that are more apt to have an appetite for your individual scenario. Give you an example. If you're self employed, the likelihood of some banks having a problem with stability are a little higher. As a broker, we can go to wholesale lenders. The rates aren't higher. They just go to a wholesale lender that purchase loans in wholesale fashion. In other words, they're buying full completed loans as an investment, and sometimes those loans can be and funded just because the deposits for the business have been solid for 24 months. So your individual situation doesn't necessarily disqualify you because you're a business owner or anything like that. But what we don't like to do is look at the overall scenario and place you with the best lender. And we have those options as a mortgage broker. That's another way you can get the best interest rate. The next step, finding an individual broker or lender, is you want to look at their reviews online. Basically, are they credible? Are they someone that does what they say they're going to do? Here at United Lending, we're the highest rated and most reviewed company along the Treasure Coast, and we're proud of that. But it took years to develop that, and I think that that's one thing that we recommend that you always look for is a reputable company that will take good care of you and has a solid history of taking care of others. The other thing we do to get the best interest rate is once we dial all those things down, we look at the market rates every day. There's something we call Market Watch. Actually, we subscribe to three services. I'm either text or email, given a call from the service that we subscribe to that lets us know if the mortgage market is moving up or down. In other words, interest rates go up and down all day within a given day. And so a lot of times people don't understand that. Well, how did my rate change over the course of the last week? Well, they change daily. And so knowing when economic events occur in real time, we can actually lock loans ahead of those moves. Flip side's true too. If the market conditions are improving, we don't lock the rate. We allow the loans to float up, the bonds to float up, which is a decrease in interest rates. There's a inverse relationship there. So we watch the bond market in real time to make sure we lock at the opportune moment for you and your timeline as to when you want to close. If you found this video useful today, drop a like below and be sure to subscribe to our channel. And for our market minutes, we're dropped 3 times per week to let you know what interest rates are doing in real time. You can find them right here. And for our lessons in lending series, how to get that best interest rate, the broker versus banker model, I think you'll find it very useful. You can find them right here. Again, my name is Brent Starts with United Lending, and this has been your Lessons in Lending.